Good morning, everyone. We hope you're all safe and well. Welcome to Property Post Pandemic, a global view with Victor Calanog of Moody's Analytics from New York. We'd like to acknowledge Entrepreneurs Organization's Construction, Engineering, and Real Estate Group, some of whom join us today. Thank you very much for that. Our guest today, Victor Calanog, is Head of Commercial Real Estate Economics for Moody's Analytics. Before joining Moody's, or before Moody's Prior to that, he was chief economist and senior vice president at Reese before it was acquired by Moody's. He leading a team of economists and analysts building the firm's data marketing and real estate analytics services. Victor will discuss how COVID-19 is affecting the property market in the US. We invited him because we believe you'll get many insights you can apply locally. Before I turn over to Victor, allow me to invite Bobby D, President and CEO of Ayala Land, for brief opening remarks. Bobby?
Thank you, Coco. Good morning to everyone. It is my privilege to open this morning's virtual meeting. We are very honored today to have Dr. Victor Calanog to talk about his insights on the U.S. Property market. As an expert in the commercial real estate market, Dr. Calanog's work has been presented in meetings and academic forums sponsored by some of the most prestigious institutions. And I'm really looking forward to Victor's talk today, primarily to get insights in markets outside the Philippines. Although real estate is a very local business, we are really part of a broader global economy, and often we see similarities in trends in various parts of the world that would be applicable here in our local setting. But before I pass it on to Victor, I wanted to share briefly our own insights at Ayala Land on this pandemic and its impact in the property sector in the Philippines. I want to leave you with three thoughts. Okay, first, our country, Philippines, is well positioned to recover from this crisis. What gives me this confidence? I think first and foremost, our macroeconomic fundamentals continue to be quite stable. If you look at our interest rates, it is actually now at historic lows. Our inflation rate continues to be low, and our exchange rate continues to be quite stable. These factors are actually conducive for further investments. Secondly, our country's fiscal position continues to be strong, with a lot of space or room to pump prime and restart our economy. Recently, The Economist magazine ranked us 6 out of 66 countries to be best positioned fiscally to weather this crisis. As you know, also the Japan Credit Rating Agency, or JCR, last week upgraded our credit rating from BBB+ to A-. Government is also prepared to run a significant deficit this year. They're now forecasting 9% of GDP to pump prime and restart the economy. This is a significant amount and is in line with the deficit spending that we see in some of the ASEAN countries like Singapore, Vietnam, and Malaysia. My second point is property, I believe, remains to be one of the best investments here in the Philippines. We are no strangers to crisis here in the Philippines. Personally, I've experienced the 1984-1985 debt foreign exchange crisis, and again, the Asian financial crisis in 1997. In both crises, they were actually quite deep, but we saw property prices recover quite nicely subsequent to the crisis. If you remember 1984, 1985, our GDP contracted by, I believe, 7%. And in the Asian financial crisis, we saw it again contract by about 1 to 2%. And we saw property prices go down. But since then, as you know, we've seen property prices again move back and resume its historical trajectory in terms of property appreciation. If you look at longer term trends on property prices, taking into account various economic cycles, property, and if I may add, Ayala Land property in particular, sorry for the shameless plug here, I believe continues to be one of the best, if not the best, performing asset class. Let's take, for example, Ayala Bank. We launched Ayala Bank back in 1978, so about 40 years ago. And we sold the first property at about 230 pesos per square meter. Today, property prices at Ayala Alabang are trading at about 100 to 100,000, 110,000 pesos per square meter. So if you look at over the last 40 years, that's a compounded annual growth rate of about 16 to 17%. Let's take a longer period. Let's take, for example, here in Makati, let's say Forbes Park. If you take a look at in 1969, about 50 years ago, property prices at Forbes Park were trading at about 200 pesos per square meter. Today, I think you're looking at about 400,000 pesos per square meter. So over the last 50 years, the compounded annual growth rate is about 15 to 16%. No? But today, I get asked by many people, no, by many investors, will there be a price correction given COVID-19? And my response are as follows. First, and we do get a lot of information and offers from people. No? We've not seen a meaningful reduction in prices. No. Uh, Secondly, of course, given this crisis, there could be some downside, but I don't expect the price reduction that we saw back in the Asian financial crisis. And the reason for that are as follows. First, people who bought over the last few years are not really highly leveraged. We don't get the impression that people were borrowing a lot of money, particularly in the upper end of the market and in the commercial land transactions. The funding basically came from, I guess, wealth creation in our economy over the last 15 years, and people were basically investing in property as part of their portfolio allocation. Secondly, interest rates continue to be at historic lows, which basically bodes well in terms of keeping asset prices fairly stable. And finally, there's just so much liquidity in the market today, looking for investment options. So this is very different from what we saw back in 1997, 1998, wherein interest rates went up to as high as 20%, and we had some sort of a foreign exchange crisis. That's something that we're not seeing today, and therefore creates that semblance of stability in the market. My third and final point is, sector recovery within the property industry will vary. I'll give you our own experience here at Ayala Land. We find that our office sector, in particular, has not been significantly affected with the pandemic. There's not been any meaningful cancellations in terms of leases, and our tenants continue to basically pay us. Warehouse logistics also has not been affected. We're seeing some activity now in the residential sector. In fact, we're a bit surprised. What we saw in April, despite the ECQ, we continue to sell inventory. In May, again, we saw a month-on-month increase, and again in June, month to date, we're again seeing an increase. Nowhere close to or nowhere near the pre-COVID levels, but at least we're seeing some encouraging signs that the market continues to be there, and we're hopeful that as the economy reopens, that will gradually move back to previous sales levels. Our malls have been hit hard, no doubt about it. Foot traffic today is only about 10 to 20% pre-COVID levels, depending on the mall. But we expect a gradual recovery as the economy continues to reopen. But really don't expect a full recovery until such a time where people can freely congregate and entertainment is again allowed in our various shopping centers. Finally, hotels and resorts, we're not seeing any meaningful activity as well, given IATF regulations. I think full recovery is a long ways off and will only happen when people can actually travel freely, both business people as well as tourists. So before I turn you over to Dr. Calanog, I'd like to thank Makati Business Club for doing your part to help amidst this global pandemic. Through the years, you've brought the business community together to ensure business continuity, to protect the community, and enable better collaboration with government. So again, thank you. And once again, good morning to all.
Bobby, thank you very much for that and for the compliment at the end. Thank you very much for that. I'll invite now Victor to give his presentation. I didn't know Victor a few months ago, but I trolled the internet and I saw this great speaker. You be the judge whether he's knowledgeable or not. I just know he's a great speaker. Victor.
Thank you, Bobby and Coco, for that great introduction. I was trying to coast on just looks and form and not content. But now that Coco has pressured me to deliver some kind of insight to the group, I guess I'll have to do so over the next 15 to 20 minutes. Now, what I wanted to do really quickly is give you a quick overview of the US economic landscape, how that maps into our view at Moody's Analytics of the multifamily and commercial real estate markets, and how we might want to think about where distress and opportunity are manifesting given the COVID-19 crisis. With that background done, we'll open the call to questions and answers and see which ideas, trends, and future possibilities are more or less relevant to the Philippine situation or the global context as a whole. Can we move on to the next few slides, please? One more. One last. Thank you. Here in slide 4, what I do is to present annualized growth rates for quarterly GDP in the US, focused on our forecasts for the remainder of the year and beyond. There are 3 lines in this chart. I'll walk you through it. One for our baseline, the other 2 for 2 downside scenarios that try to quantify worst cases where, for example, reopening is not as smooth and reinfections occur, which is happening today. So the worst case scenario is represented by the dark blue line. It's labeled protracted slump, where, as you can see, GDP growth remains below the horizontal 0 line until late 2021. Again, that's the worst case scenario where basically we take our lumps, parang sinapak tayo ni Manny Pacquiao in the second quarter. All lines show that massive dip in the second quarter, and the recession lasts as long as 2008-2009. It started in February. It does not end till the third quarter of 2021. Now, that's the worst case scenario. And what's the main point of this slide? Number 1, the second quarter is going to hurt, and it's going to hurt in an historically severe way. We expect annualized GDP growth to be anywhere from negative 30 to 40%. That is 3 to 4 times as bad as the previous record of 10% in the first quarter of 1958. So just visually speaking, you can see in the slide, you know you're in for a rough time when all 3 of your scenarios, baseline plus 2 downsides, look very much the same. But there's good news, diba? We created 2.5 million jobs last May, according to the Bureau of Labor Statistics. I mean, the recession is over, isn't it? And take a look at the next slide, please. Actually, we are not sure. Here in this slide, I dig a bit deeper into the numbers and show some interesting patterns. First, about half of the jobs that were created in May were in the food services and drinking places category. So for Mr. Tan Mantiong, who's here representing Jollibee Foods Corporation, that is good news. That's 1.37 out of 2.5 million jobs, and I suppose that makes sense. We dug ourselves into a really deep hole from March to April, and with restaurants and other dining places 100% closed, even reopening at 50% capacity means a pretty big swing in rehiring workers that were furloughed or laid off. So sure, there are green shoots in that report that you can hang your hat on, but hold your horses, because if you take a look at the bottom chart, you will see that we continued losing hundreds of thousands of jobs in government, mostly local government jobs and accommodations or hotels. So over Memorial Day weekend, the big holiday here in the US in late May, this data doesn't capture it, by the way, I was on industry calls where it was estimated that, sure, hotels seem to be back to 80% occupancy rates, at least from the speaker's specific portfolio. He was from one of the largest banks in the country. Now, I really didn't know whether to be happy for hotels that people began traveling again, or worried that reinfection rates would begin spiking. I don't know when now, right? So newsflash, about 22 states in the US are spiking cases in the first week or 2 of June. So next slide, please. It's still a mixed bag. we are reopening the economy and we are figuring the situation out. What does that mean for CRE, commercial real estate markets, and related debt instruments? Let's turn to that now. Next slide, please. So if you take a look at the US debt markets, there might be opportunities here, right, for distressed assets given properties that might not be able to service their debt. And according to the latest estimates from the US Federal Reserve, the total balance of multifamily and commercial real estate loans is around $4.6 trillion as of earlier this year, pre-pandemic. Depending on your view of that elephant, or more precisely, your exposure to specific property types and geographic markets, well, you will either be less worried or more worried. So if you look at Life Coast, this would be MetLife, PGIM. No, these are insurance companies which hold about 12% of the total debt pie. They are not as exposed to hotels. You can see that on the pie chart on your right. That's good for them, but they're not off the hook because, as you can see in the pie chart, 22% of their portfolio is typically in retail. Next slide, please. You will often hear news about commercial mortgage-backed securities, or CMBS, because it is the most transparent, frequently updated slides of the US real estate debt pie. So from the previous slide, it's about 9% of the total pie, but I don't think it's a surprise that the majority of distressed loans, and we will define distress very carefully as we go along, no, are centered on hotel and retail. If you take a look at about $42 billion of CMBS loans that mentioned COVID-19 in servicer comments, very detailed. Now, about 70% are hotel and retail loans. That is the chart on the bottom right. Now, not all of these loans are delinquent. Many are current, but we do pay attention to indicative signs. It's like those annoying phone alerts that you get. It might not even be relevant right now. Oh, may bagyo in your area tonight. But the moment any servicer comment says COVID-19, then our structured finance group at Moody's tracks this in real time. It does raise flags, and we probably should monitor what's going on in those loans. Now, what are actual companies experiencing? Last week, we published a paper on the experience of special servicers. Now, we had Jim Shevlin and Don Warsholak, that's COO and Managing Director of CW Capital, as special guest. CW Capital is one of the largest special servicing firms in the US. They gave us access to some of the data that they've been seeing, and it's really interesting that from their point of view of the world, the distress is manifesting in similar ways. It was really interesting for me to hear Bobby D basically saying hotel and retail are also suffering quite a bit, because as you can see in the pie chart on the left, CW Capital's experience from relief requests, not delinquencies, but a good indicator nonetheless of future delinquencies, right? About $8 billion worth of unpaid balances for loans they were either monitoring or servicing. Check out some of these statistics. First, surprise, hotel and retail, majority of relief requests. Not a surprise at this point, but let me give you some perspective from 08 and 09. Back then, the recession started in December 2007, but CMBS loans in special servicing, nalipat na to special servicing, did not peak at or around $90 billion till the second quarter of 2010. That's 2.5 years in, no? Now we're about 3 months into the COVID crisis, and I believe that we are close to $35 billion now in special servicing, a doubling from about 1 or 2 months ago. That is fast. But wait, here's the second insight. From CW Capital's experience, only 7%, or about $600 million worth of their unpaid balance of $8 billion in surveillance was moved to special servicing in May. Well, at least when we wrote the paper a week and a half ago. But there's still a process to follow, no? Relief requests to actual delinquencies and being moved to special servicing. Finally, before we move on, CW Capital also noted that they rejected 29% of all relief requests outright after further investigation of the borrower's actual ability to meet debt obligations. There just wasn't evidence of real distress based on the tenant mix, based on the borrower's actual situation, at least as far as CW Capital due diligence could detect. And we had warned about this moral hazard when this shutdown began, because, hey, if the tenant or borrower beside you is asking for help or support from the government or other institutions, then why shouldn't you? So as usual, execution and implementation matter, so that the right kind and amount of help go to the right institutions and people. So next slide, please. What does the future look like? Well, let's take a look at the somewhat immediate past. We know that we've been shopping more online, and even more so since this pandemic took root. My social media feed is ripe with all sorts of complaints about Lazada and Shopee and so on and so forth. But what do the US numbers actually show? Moody's Analytics estimates that during the months of March and April, the proportion of e-commerce relative to total retail sales, and you can see it in this chart, spiked by 500 basis points from 11.4% at the end of 2019 to 16.4% as of the latest figures. The share figure had been rising steadily since the dawn of e-commerce in the late 1990s, but the magnitude of the spike over 2 months really prompted by COVID-19. It's historic. Next slide, please. I do think we need to make careful distinctions about the type of retail we're talking about here. And often we'll need to go case by case. First, the big box retailers that you'll hear about in the global news, distress from Neiman Marcus, JCPenney, we all know these names, and they tend to have retail presence concentrated in malls. If the main tenant is a grocery or a pharmacy in a relatively smaller neighborhood and community shopping center, the main tenant is likely still open for business and need not file for rent relief. For the case of Macy's, as you can see in the map here, and right here in this chart, they have actually a retail presence in over 200 counties. This is a heat map of COVID-19 cases and intensity for each county in the US. But for Macy's, the top 20 counties out of 200 account for 1/3 of all the space that they occupy. What's the largest concentration risk? Over there on the West Coast, LA County, where they have a presence in over 29 stores, about 4 million square feet of space. And not coincidentally, LA is the epicenter of COVID-19 in California, with about 50% of the state's cases. So again, we return to central themes like concentration risks, idiosyncratic risks based on specific businesses and places. Next slide, please. What about office space? Don't expect to see a whole lot of movement in the office sector, even in the second quarter. Bobby D really hinted at this, but because the optimists will point to the usual long-term nature of leases in office space. You sign a 5 or 10-year office lease, unless you totally go out of business, you probably will not renegotiate. But with that said, in downturns, if you go out of business, well, guess what? You do break your lease and you do renegotiate. Back in 2008 and 2009, New York City rents fell by 19.8%. It was the epicenter of the financial services meltdown. This time, New York City is once again the global epicenter of COVID-19, at least at the city level. So the Real Estate Board of New York estimates that the physical occupancy of office space in New York City, the largest office market in the country with 400 million square feet of space, went from 97% physically occupied to 3% between March and April. There's just no one going to the office. So when do we all go back? What's the future of office space? You have big firms in different industries, Morgan Stanley, for example, issuing very definitive statements, really bold statements about reevaluating their need for office space in the future, given how they've proven that they can continue operating in remote environments. But take the case of Google. I think we should step back and ask a fundamental question. If Google and other tech companies had always been in a better position to allow their software engineers and other employees to work remotely, then why do they occupy close to 5 million square feet of office space in New York alone? Now, reasons range from using office space as a recruiting tool. Oh, it's so cool. I'm a young, hip engineer. I'm so smart. I just graduated. I want to work for Google because they feed me. I can ride my scooter around the headquarters in New York. So there's so much space. Awesome. Or making sure that their teams are supervised better. But regardless of the reasons why they currently occupy or use so much space, I think we need to think about the future, because whether this crisis might prompt them to evaluate or shrink their use of office space in the future. As we see here in this chart, Bay Area and San Francisco are therefore at the greatest risk in terms of the share of the size of space occupied for existing leases. If you take a look at other markets like Washington, D.C., maybe it's not at risk because it's not as much of a risk because they're not as dependent on tech. But I wonder, even for public institutions, are they wondering whether their office footprint is appropriate? So next slide, please. Let's shift to some good news naman with multifamily. Prior to the outbreak of COVID-19, we were expecting about 300,000 multifamily units to come online in 2020 alone. That would have been a 20-year high. The sector has been building a lot, but you know what? The supply growth was really justified by demand. If you take a look at the vacancy rate, it really dropped to as low as 4.1% versus the long-term average of 5.2%. At the end of 2019, we are at 4.7% vacancy, still very tight. So you've got a sector that's entering the downturn in a position of relative strength. Our forecast for multifamily is that because construction has been deemed non-essential in some places like Boston, but essential in some places like Texas, there will be only about an 18% decline in construction activity, which actually is a boost for vacancies because you don't want oversupply when your demand has contracted so much. Now, that will just complicate the recessionary situation. So in that sense, multifamily is a relative winner. With all that in mind, I just wanted to spend a couple more minutes discussing our near-term view of the future. Forecasts will necessarily change. Next slide, please. But for the past couple of months, it looks like that our view, ordinarily speaking, rank order, no, is that retail will suffer more than office. Office will suffer more than industrial, and industrial and multifamily will suffer, but not by much. No, we present our cap rate forecast here in the slide with implied value declines. We can argue about specific numbers down to the 10th or 20th decimal place, but I think the rank order of where distress is showing up seems consistent and has not changed much. We will see and we'll continue to monitor. Next slide, please. So I know I've been talking very fast. I'm sure you're all pumped up and excited because of all the sunshine that I've been bringing with me. But all kidding aside, it's a serious situation. There's a lot of uncertainty and we're often left asking, what can we really know? Everything we've discussed here tends to be based on economic forecasts because our job at Moody's is to help our clients quantify how bad it could possibly get. But we need to remember that there are a lot of moving parts and there are a lot of things we can't know. So there's the possibility of an upside. How do we think through the end game? Well, think about major shocks like earthquakes, hurricanes, and terrorist attacks. How did that change the real estate landscape in affected areas? Next slide, please. In '94, there was a major earthquake that devastated Los Angeles. The epicenter was at Reseda in the North Hollywood area. Today, it became known as the Northridge earthquake. It remains the costliest earthquake in U.S. history, about $27 billion in damages in 2018 terms, according to Munich Re. However, if you take a look at the before and after in this vertical line in the chart, almost counterintuitively, the earthquake actually didn't impact property fundamentals in a sustained negative manner. It's because the area did not suffer a permanent long-term shock to demand. Households and employers kept flocking to Los Angeles. The city benefited from the urban revitalization that swept across the nation. By contrast, next slide, please, New Orleans did not fare anywhere near as well after Hurricane Katrina in 2005. It is also the most damaging earthquake in U.S. history at about $160 billion worth of damages. New Orleans suffered a one-time loss of about one-third of its population throughout late '05 and '06. As of 2019, New Orleans has yet to recover its population levels from 2004. So improvements in commercial real estate slowed over the long run. Finally, what about terrorism? What happened to downtown New York after 9/11? That was the worst terrorist attack in U.S. history. Next slide, please. It was very easy to make predictions, and some were made about how New York and places like Washington, D.C. would suffer a permanent outflow of households and employers after 9/11. In the short run, sure, some employers left downtown Manhattan. Some households did too. But what happened after that? It was literally a residential renaissance. Who wants to live in downtown Manhattan? I did. I moved down there in 2009 when my daughter was born, and I raised my kids for 8 years there before we moved out to the suburbs 3 years ago. So we were raising our kids in the shadow of One World Trade Center as it emerged. So what will it be? Will it be the optimistic case where COVID-19 is going to be a temporary blip that we'll forget quickly and will not affect property incomes or values that much, like, the occasional flood or brush fire in the United States? Or will it be the pessimistic case where the amount and quality of demand for real estate fundamentally changes? I think the distinction we need to make is twofold. Number one, the shock of even something as terrible as 9/11 still affected particularly local areas. Yes, it changed the way we travel through airports forever, but it still affected downtown Manhattan and Washington, D.C. COVID-19 is a national and a global shock. The second distinction we need to make is that these shocks tended to be fairly short in duration, although Hurricane Katrina was dragged on for a few weeks. When will COVID-19 end? Until we have a credible, reliable, widely available vaccine and treatment protocol, it's probably going to feel like 2 steps forward, 1 step back. And the longer this remains, I think the longer the things that we think are not normal will become habituated. So let's see. No, a lot of it is we will see. But for now, I wanted to end because I've been talking nonstop and I need to take a breath. I want to end this quick overview and open it up to any questions that you guys might have. Coco?
Thanks very much, Victor. If anybody in the audience has questions, please type them into the Q&A box, and we'll read them more or less in that order. I have some questions myself, but as soon as there are questions there, then I'll defer to those questions. And maybe I could tell the participants also, when I think about Victor's presentation now, maybe you can frame your thoughts or your questions along at least 2 lines. First, why are we interested in the US, which is obviously Victor's expertise. First, how the US economy recovers will have an impact on us in terms of OFW remittances, exports, et cetera, et cetera. So we can ask Victor some of those questions about the US economy in general. The other is particular segments, which I see when I look at the participants list today, I see representatives from various real estate sectors. If we can ask Victor, if you would ask Victor specific questions that may relate to your sector here and how he might relate that to his sector there. So just as just to get that started, and again, please, I invite you to write your questions in the Q&A box. Victor, when you look at the US economy, you're predicting a relatively quick, I think, recovery. It's the view here for about the local economy is more uncertain or certainly not as fast. Could you tell us why you think the US economy will recover as quickly as you think it might?
So, thank you, Coco, for that question. Our baseline forecast, which is in line with epidemiological forecasts for how COVID-19 will progress, although that's changing all the time, is that the U.S. economy will recover and or reopen, not recover fully. No, there are many definitions of recovery. Will the recession end? Will you go back to GDP levels before COVID? No, but if you define recovery as reopening and therefore the resumption of economic activity, well, we've started to do that. No? Our baseline estimate is that in the 3rd quarter of 2020, GDP growth will be slightly positive. And then funny enough, in the 4th quarter of 2020, it will be slightly negative as the positive or salutary effects of fiscal policy wind down. In other words, Paycheck Protection Program, historic level of support from fiscal and monetary policy, that tends to have a one-time effect, just like the tax cuts of 2017. It really didn't last the following year. So once that sugar high comes off, then you'll have a little bump in the road in the 4th quarter. So if you take a look at 2020 as a whole, we are expecting the U.S. economy to contract by 6.6%. That doesn't sound like much, but you hinted at it here. Why should you care about the U.S. economy? Well, it is a $20.5 trillion juggernaut that comprises 25% of the world economy. We all like to talk about China these days, but China is a far 16% of the world economy as of 2018. They are the number 2 economy, but there's a big difference between 1 and 2. So in other words, Coco, I think your point is, if the U.S. catches a cold, it's pretty likely that everyone else will catch the flu. I'm sorry, that's a bad analogy given COVID-19, right? So we are quote unquote ailing. We are going to recover, but 6.6% is a severe downturn. So I don't want to give you guys the wrong impression that we're relatively optimistic. 6.6% is about 1.5 to 1.6 times as bad as 08 and 09. And 08 and 09 happened over 18 months, no? 6.6% is expected to happen in 12 months, mostly in the 2nd quarter. Talagang parang inupakan ka no 2nd quarter. You're trying to get up. OMG, reinfections, you might go down the mat again to extend the really bad boxing analogy. Now, so 6.6% is bad. slightly positive the next year. But again, when you take a look at the long-term growth rate of the US, we're not expecting it to be above 2%, no? So this is not like a V-shaped recovery in any way, shape, or form. And to your point, I don't think this recovery will be consistent until, as we spoke about with Bobby earlier before the call, in the pre-call, until we have that treatment or vaccine option that really restores confidence and gets people traveling. Dami kong sinasabi, no? Sorry about that. So I think I tried to answer your question as concisely as I could, believe it or not.
Yeah, I think when I was saying that you had a relatively good view of the recovery there, I was speaking relatively compared with how we or some other countries are looking at our own recoveries. Our first question will go to a former student of yours, Raymond Rufino, who asked the first question relating to offshoring and onshoring. Raymond?
Hi, Victor.
Hey, how are you,
Great,
Mr.
great to
Rufino?
see you. Good, good, great presentation. So my quick question is offshoring versus onshoring, right? So we know that in the U.S., a lot of U.S. companies have been offshoring as a critical part of their business strategy, right? But given this push toward, sort of nationalism, this requirement for a lot of companies to hire because of the job losses in the U.S., do you think offshoring will suffer as a result, or do you think the economic sort of benefit of offshoring is going to be so compelling and even more important during this time that companies in the US will continue to grow their outsourcing component?
Yeah, that's a great question. And I think the best answer to that is we will see. I'm sorry, I'm such a fence-sitting economist, no? There are many things aside from nationalism. You run your own business, right? So if you're a manufacturing facility with a global scale of operations, you're going to make decisions where you're going to make the most money, no? Very simply put, whether it means there's more subsidies because the government wants to give you money to onshore, or there's lower taxes because I'm not sure Vietnam has a 20-year tax holiday in its, export processing zones or something like that. I think the interesting thing is, whether it's offshoring or onshoring, we want to see on the margin where the global supply chain ends up if it's true that China loses its luster, or some, if not all of its luster, some of its luster in the global supply chain arrangement, no? So in other words, let me talk just real quick about the US. On Wednesday, I'm going to give a webinar with the CFO of Prologis, which is one of the biggest industrial landlords there. And one of the topics we'll discuss is precisely this, because onshoring might actually hurt the warehouse distribution subsector of the United States, diba? A lot of warehouses are being built where? In the West Coast. Because a lot of the global supply chain located in Asia ships through the Pacific Ocean to the West Coast. That's why you see a lot of ports in LA, and you'll see news about, port riots or like port protests. When the guys at ports go on a strike, it makes the national news because 60% of all U.S. trade goes to the West Coast. And then a lot of trucks ship it to Chicago. That's why in Chicago, you see a lot of crates going back to the West Coast for the markets in the East. What if the global supply chain is reoriented so that now you're in countries where it's more efficient to ship through the Suez Canal, right? All the way to the Mediterranean and through the Atlantic, straight to your East Coast markets, which have been by the, or around the Panama Canal, diba? Not to the West Coast anymore, but through the Panama Canal, which has been widened over the last 12 years, all the way to your East Coast markets. So I think on the margin, we want to look out for that because there will always be people who will be hurt, like warehouse distribution in LA or the Inland Empire. That might not be as good a proposition now if it's true that it's onshored. Who will win will be the manufacturing facilities, probably light, not heavy. You're not going to leave the low-cost countries for that. Light manufacturing might go back onshore. But the global supply chain trend is like a big battleship. I do not think you will be able to steer it just because of a quote-unquote a crisis like COVID-19, although it is a major crisis. So let's see. We're monitoring the global supply chain and where it ends up, and I think that will ultimately impact the value of specific properties because of where they're located.
Thank you, Victor.
Raymond, you have a follow-up to that?
Nope, I'm good. Thank you.
So I think, Victor, if it wasn't clear, and maybe to some of the audience, the interest of many developers here when it comes to offshoring and onshoring is office space for the BPOs. And
yep.
maybe more than on the industrial or manufacturing side. It's really office space and BPOs, which have been, Raymond can tell you this, Bobby D can tell you, others can tell you, have been a big tenant, even in relatively high-end office space in the Philippines. So I think that remains a big concern.
And our biggest competitor in the BPO space is not China pa rin, ano? They're coming up behind India, but it's still India, right? Is that a good characterization of it?
It remains India. Depending on which segment, Philippines and India are number one or number two.
Yeah. So I think it really depends on the hat you're wearing. No? If you're the NEDA, and someone's got in NEDA who was also a few years behind me in Ateneo, right? If you're in NEDA and you want to encourage economic development, then what kind of fiscal policy will you recommend to the administration to support which businesses and sectors, right? If it's BPO, I know business process outsourcing got a bit of a bad rap in the beginning because, a lot of college graduates who thought very highly of themselves ended up working there, and then you're going to get a degree in Ateneo, tapos magtatrabaho ka sa BP. But you know what? Honestly speaking, from a developmental point of view, it's probably the appropriate industry for the Philippines given our labor structure, no? And that's why it actually really took off, because it's appropriate. I don't think we were necessarily built to leapfrog into high-tech and manufacturing industries, although I know there are segments that cater to specific areas of the tech industry there. No? So again, a lot of it depends on the hat that you're wearing. If you're one of the guys who are running the BPO companies, I do think you are looking over your shoulder, taking a look at competitors from India and China. And I'm not sure that threat will disappear because of COVID.
Thanks very much, Victor. Our next question goes to Miguel Garcia, who also is invested in the same sector. Miguel?
I just wanted to comment on Raymond's question. I believe the O&O industry is going to continue to grow. A lot of our customers are wanting to expand, obviously with social distancing. So that's a good thing. Just like the GFC crisis in 2008, 2009, it was a bit slow to take off, but right after in late 2009, a lot of our customers really expanded because they had to bring their costs down. So I think that will be a positive thing for us in probably Q4 or Q1 of next year.
Miguel, could I ask you a question?
Sure.
Hi. When you said that expanding because of social distancing, I'm not sure if you were talking cost and effect there.
But we have one large, without mentioning the name, one of the major retailers in the world, e-retailers in the world. I spoke to them the other day and they said, hey, Miguel, we need 4,000 more seats in the Philippines. Obviously, we only need 2,000, but because of social distancing, well, we're going to need to spread them out, right? And this is in line with their seasonality, Christmas coming along. So that's an example of a customer that will need to expand.
So not necessarily more workers, but definitely more space, Miguel.
Not more space, but more workers as well.
Victor.
Miguel, Raymond, Coco, I turned out a lot of negative numbers in this forecast, though. That's the baseline forecast. I don't want to sugarcoat the situation because it's pretty serious and there's still a lot of uncertainty. But I've got to say, there has not been a point in my career, 20 years running in economic forecasting, where I'm hoping that I am wrong on the downside. I totally want a situation where 1 year from now, if I didn't totally bomb this and bore you guys to hell, Coco will invite me back and say, Victor, let's pull up your slides from June 15, 2020. And what happened to your forecasts? It looks like everything turned out rosy, uminit, nawala yung COVID, I don't know what happened, and we're all fine, and we're all traveling, all those trips to Italy that Raymond postponed for his family, now he can go, right? I've never been at that, and I guess where I'm coming from is, I have two young kids, one of whom is right here, that's why I have a virtual background, no? I have to be optimistic. No, I know I'm an economist. I'm built to be somewhat pessimistic, but I need an asset bubble to fund these guys' college education, right? So there's never been a point in my career that I wish that on the down. Now I think that's what everyone wants to do at this point. We want to prepare for the worst, but hope for the best, right? So I'm a big cheerleader for that.
There was an article in Bloomberg the other day that's saying even work from home is challenging in the Philippines. And a lot of the BPO, not only the captives, but the BPOs are once pandemic is done, they will need to grow.
Yep, and I think to your point, guys, as entrepreneurs and business owners, what is your best response strategy, right? If you are blessed that you have the resources and dry powder to weather the storm, you want to invest now, right? Para to take advantage of the growth, because believe it or not, when we do recover, your competitor will be there. What's your best response? It's actually to position yourself now so that when growth resumes, and we all have to hope that growth resumes, you're in a better position than your competitors.
Miguel, do you have a follow-up?
No, that's it. Thank you.
Thanks, Miguel. Victor, one of the questions, I guess, staying with this offshoring theme, is that as unemployment lingers in the U.S., hopefully not worsens too much, but lingers, will there be a political action there where they will discourage U.S. companies from offshoring, and how could that affect us?
I would like to be in Nate Silver's position. Actually, I wouldn't, 538, and make political predictions about where policy will go when it comes to economic policy. But unfortunately, this is also the administration that's proven to be the most unpredictable when it comes to these policies. All we can sense on our end, because we do have political analysts at Moody's, that give us their read of the world, is that it is true that as the world evolves towards more of a rightward tilt, more nationalistic, they are not as open to international business. And so I think that folks who think that globalization is unstoppable and so on and so forth, we're out, you'd be surprised. We rolled back a very globalized world in 1914, though of course it was because of a war. I don't know what will happen when it comes to this administration. It's very nationalistic, and depending on who gets elected in November, I think we'll have a clearer view of the relative friendliness towards international trade. But otherwise, there is that, for me, a worrisome rightward tilt that's not very friendly to international business, unless it serves their ends. Suddenly, if they can build something there, it might be a hotel. Suddenly, it's okay. So it's a little frustrating.
Victor, you must know, or I'm sure you know, in the Philippines, the shopping mall is a bigger part of the culture than it is in many countries. So I guess many people are looking at that and figuring out what's going to happen there. How is that going to improve? We care about that as consumers. The retailers, whether food or clothes or whatever, care about that for traffic, and of course the landlords care about that for rent. How has it developed in the U.S. in the last I'm going to say the last few weeks as it begins to open up? What comes first? The opening. How quickly do the people come back in once a city or an area begins to open up, and then how fast does it get up to a decent level?
No, so I am definitely more hopeful about the shopping mall and shopping mall culture in the Philippines for a variety of reasons. Here, it's been murder. So if you take a look at the mall vacancy in the United States, we were at 9.7% at the end of 2019. We were already seeing vacancies rise from a high of 9.4% in 2011 in the last downturn. It's been creeping upwards, so it's actually been high at its highest level in the last 15 to 20 years that we've been tracking this small type, There have been very, very big deals, including the purchase of Simon Property Group of Taubman. It would have been a $3.6 billion deal that was scattered just a few days ago because of this retail debacle. And as even the strongest, again, the world of have and have nots. I say 9.7%. I quoted Simon Property Group. Simon Property Group operates about 400 plus regional malls and outlet centers in the US. Their vacancy rate is about 4.2%. So talk about the world of have and have nots, no? If your average is 9.7% and Simon is at 4.2%, with about 15 to 20% of the total market, can you imagine the have nots? They're at 14, 15% vacancies and rising. So as the economy reopened, even Simon has had to backpedal in places like New York and Indiana because it's not just, oh, it's time to reopen. It's phase 1, it's phase 2, and literally Indiana's governors told Simon Property, no, you can't reopen. Sorry. They plan to reopen about 47 places. I believe they were only able to open about 30 to 32. No? So it's interesting. Even the strongest players in the mall sector are finding it hard. Now, with that said, everyone here in the US was trying to reposition the mall, not simply as a place to buy goods, but a place where you can experience something. That's what pulls you into malls, right? Whether it's movies, whether it's water slides, whether it's, I don't know, whether it's a concert, the Jonas Brothers are playing here. And then when you're in there, sana bumili ka na sa Apple stores, that's when you benefit. It's become, the pitch is experiential. But with this COVID-19 crisis, suddenly that experiential pitch is also in trouble because of social distancing. Why am I less worried about the Philippines? So let's pivot, let's switch to the Philippines. It's because we never needed to work on the shopping mall as an experiential destination, right? We kind of started with that. Diba? Would you really only go to a mall to buy something? Well, at least my wife doesn't, at least my family. It's you're there for hours, diba? Or either, in the cliche is nagpapalamig ka lang kasi may aircon and mainit sa Pilipinas. That's probably true. Layer it on with the innovations that Bobby's company has done and other retailers have done. It has become more exciting. I go to festival mall. I was there. What did my kids do? They had virtual reality, and I didn't know there was a roller coaster in the middle, diba? So we can watch. It's always been the experiential pitch. And correct me if I'm wrong here, as the Philippines reopened, how is, Bobby said 10 to 20% occupancy in malls, but I think people are coming back, no? I'm kind of teetering in. Certainly better than the US, I think. Huh? What's your overall read of the situation? For good or for ill? Kasi we worry, babalik sila, and then, but right? Are people back more or less?
Before I turn over to Rick Santos, who's one of the biggest property consultants in the country, I'll share a little bit. We had a focus group discussion, and some of you were part of it last week with the government about this. And one big developer said, for example, everyone's expecting online purchases to really ramp up, stay at this level and ramp up in the future. He said, in the Philippines, maybe discount that a bit, because number one, our online infrastructure is not that great. Maybe for people in this room, yes, but maybe for the majority, no. Number two, people will still want to go to malls because, as Victor said, you want the aircon, and part of the entertainment, Victor, is the aircon. So I think that remains a factor. There was an interview yesterday on TV with Lance Gokongwei, JG Summit Group, Robinson's Retail, and of course Universal Robina, and he was saying that for their stores, he called it modern stores, which is anything from a mini stop, a convenience store, to one of their higher end marketplace groceries. Obviously, traffic is lower, but the tickets are bigger. People are buying, I guess, every 2 weeks rather every 1 week. But you contrast that with sari-sari stores. If some of you heard that interview yesterday, I found it very interesting. Sari-sari stores, not modern retail. I guess he's a supplier to those. Those are really hit bad, which I would think is a reflection of how badly hit we are in terms of employment, particularly in the lower end, who may not have the savings to to propel those purchases. I'm going to turn to Rick Santos. Rick Santos now heads now owns rather, or co-owns one of the biggest property consultants in the country. Used to head one of the biggest ones here as well. Rick?
Yeah, thanks, Coco, and thanks, Victor. I'm a big fan of your work. Just a couple of questions. I mean, your data seems, and I'm an optimist, it seems a bit optimistic on the U.S. markets. And, when do you see the bottom in light of, I mean, I know if you take a 20-year snapshot, there you go, hello. You're seeing a 20-year snapshot of, now we have Asian financial crisis, global financial crisis all together. We've got a 9/11 type event. We have a SARS type event. So we have a healthcare black swan, an economic black swan. In the U.S. now, you've got a social justice black swan. So you've got a presidential election coming up at the end of the year. You've got a lot of government funding in the market. So obviously that will go away in the next couple of months. So when do you see the bottom of these U.S. markets?
I guess the question is, sorry, did you want to say anything else, Mr. Santos? Are we good?
No, I think we're good.
The bottom, right? Yeah. So what's interesting is you're right. There's a lot of uncertainty out there. The U.S. has a lot of problems that it needs to work out. I don't think that's a surprise to anyone in this call. Social justice in the U.S., for example, is a problem that probably needed to be solved 200 to 300 years ago. And we tried it with Martin Luther King in the 1960s, and there were riots, and we were killing our presidents in Dallas back then, right? So there's a lot of uproar. And I do think if I wanted to be pessimistic about it, there are many reasons to be so. One of the most pessimistic things that I try to communicate is that the long-term growth potential of the United States has actually slowed significantly. No? Since the 1980s and the 1980s, you would bank on 3% growth rate on average. Sure, there will be booms and busts. This last recovery, this last economic cycle has shown that though it was long, 10 and a half years in, it was the longest economic expansion on record, our compound annual growth rate was really all of about 2.1%, right? And so it's really slowed partly because the U.S. has grown so large. And if you compare it with any other economy in world history, $21 trillion worth, we've actually never seen it in today's dollars in any empire in history. So do you guys have any idea of which empire in history came closest to the U.S.'s $21 trillion? You guys watch Gladiator? Can you believe it's been 20 years since Gladiator came out? I thought it was yesterday, right? We still make movies of the Roman Empire, and it collapsed in 476 AD, 1,500 years ago, right? But in today's dollars, the Roman Empire is about $60 billion. It's nothing compared to the United States. The empire that came closer to the U.S. is this language that we speak, the British Empire. If you look at it at its biggest, I'm going to time it at around 1859, the time of Queen Victoria. Yes, I'm not including the U.S. in there, so I'm not double counting. We were at the original Brexit, right, 1776, right? But they picked up China, and they came up to about 13 to 14 trillion. So we're large. We're not growing as fast as we used to. And therefore, what are the opportunities in an economy that's not growing like China or the Philippines? I think that folks in the U.S. need to be a little bit more choiceful about industries that are being disrupted and those that are on the way up. So there's a little more homework that needs to be done if your overall growth rate is only at around 2%. Also, I'm not building in a stable economic growth model until maybe late 2021 when a truly credible vaccine takes root. And so, till then, I suspect that we'll go up and down when it comes to just GDP growth, when it comes to economic activity. Hopefully, it's not 2 steps forward, 3 steps back, right? But until that happens, I think it'll be a pretty bumpy ride. On the optimistic side, have you taken a look at U.S. stock market? It's pretty crazy, right? According to the U.S. stock market, we already hit the bottom. We hit the bottom like 6 weeks ago. We're anywhere from 5 to 10% off all-time highs because, like most of us here, we want to skate to where the puck is going. And the U.S. stock market is betting on the flexibility and resiliency of the U.S. economy to get out of this hole. And so, your point, yeah, I think we could see the glass half empty or take advantage of opportunities out there and hopefully tomorrow show our kids that the glass was half full. I guess I'll end there because if it's all uncertain anyway. I did want to say though that the poor millennials, right? They're now in the second economic contraction that only happens once in a generation. Right? So we said that in 08 and 09. This is a once in a generation thing. It's horrible. The worst recession is World War II. And now the millennials are in the second once in a generation contraction of the economy and the global economy at that. So yeah. So I have faith that the millennials will solve all this.
It's okay, Victor. They have a short attention span. They probably forgot about the weight. Rick, do you have a follow-up?
They can meet us away.
Follow-up question, Victor. Thanks for the response. Just, when we went through the Asian financial crisis here in 1997. On the back of that, we saw the currency almost get cut in half. Now we've seen a record BPO sector, which creates, 1.5 million jobs and over 26 billion in revenue. How do you think the Philippines can and should in the future position themselves to continue to grow this valuable outsourcing sector vis-a-vis what's happening with U.S. multinationals and the need to outsource?
Yeah, so these all depend on reaction functions of clients and competitors, right? I think that at the end of the day, we just need to continue investing in our talent. I think we need to continue investing. Surprise, business process outsourcing is about efficiency. So hopefully we need to invest in our infrastructure and our ease of doing business in the Philippines, not just for foreign investors and potential clients in the BPO industry, but also domestic investors or those folks who are actually running the BPO industries. I think the less impediments that we put in front of them, the more we can provide the kind of infrastructure where you guys can grow, where you guys don't have to deal with a lot of red tape. And I think that, funny enough, a lot of the folks in BPO are about cutting the red tape and shortening, passport waiting times or processing of driver's licenses, right? The more of that we could transfer, then the better positioned we will be to attract future business, whether it's stealing it away from competitors in China and India or growing it organically in the Philippines. So, there's the whole government support thing and whether or not we should be more active in our economic policy and carving out things like export processing zones and lowering taxes for specific industries and so on and so forth. It's really hard. The governments have a horrible record of picking winners, right? They wanted to invest in an export processing zone in the Bataan area or the EP. I work with PEZA in the Philippines. And in general, it's great, but I often ask the question, okay, if an export processing zone is a great idea when it comes to lowering taxes to do business, then why don't you make your entire country an export processing zone like Singapore did, right? I know there's domestic industries and protection and there's all that. So the general point is the more we have an administration, both on the US side and on the Philippine side and elsewhere, that can provide the infrastructure so that we can do our business and get out of our way, I think everyone will tend to benefit. The more you put roadblocks in that, then, just little things like, can I really, what decisions are being made to renew my business license? Is that at all clear? Or will I suddenly lose my license to run a BPO business in the Philippines because of X, Y, and Z? We're not going to go into that in this discussion, right? But the more uncertainty there is about that, I do think that is an impediment to the overall growth of the industry.
Before I turn to Mr. Sanmantiong for a question, Rick, could I ask you a question?
Sure.
From what Victor has said so far, and maybe also some stuff that Bobby and Miguel have shared, what do you see in your sector? I think you're more heavily in the office space, but all over as well. What kind of feedback can you share with us?
Yeah, I think, in general, I think the whole notion that the office sector is dead is not true. I think all the metrics we've just filled up with a big U.S. bank that's coming there taking a whole building and they've been very successful and very good metrics working from the office, some of the best in the world. However, when they had to work from home, they had some of the worst in the world. So I think different than the US or European markets, I've talked with our colleagues there, is, I think the office sector still is a hub of activity here. I think BPO workers need to come into the city. The bulk of our workforce is about 24, so they like to come to the office. They want to come to the office, and they don't have the infrastructure at home to be successful. So I think with the office sector, that's crucial. I think the office sector is the hub towards spinning off, making cities work, whether it's filling the restaurants and retail, whether it's getting people to buy condos or rent condos and residential. So I think that's the crucial. So I think there's a great opportunity now to continue to expand the outsourcing sector, just like it was in 1997. I guess that's my short view.
And Rick, I think to your point, much like our discussion for retail in the Philippines compared to the US, I do think there are these natural floors to quote unquote how bad things can get in terms of substitutes and where else people might shop or whether people might work from home. To your point, yeah, working from home, it just isn't as feasible, I think, in the Philippine context as it is in European markets or US markets. So that's a natural floor to quote unquote how bad things can get for the office sector, in which case I'm relatively optimistic for the Philippine office sector as a result.
Thanks, Victor.
Thanks very much, Victor and Rick. Next question goes to Mr. Tan Mantiong.
Thanks, Coco. Victor, thank you for your presentation. Very insightful. My question is about the retail spaces in the US. Because many think that a lot of retail establishments and restaurants, even outside the malls, will close or not able to survive and reopen. How much drop will the rental cost be? How long will this oversupply of retail spaces last? And when is the right time to go in and take advantage of the good spaces?
Yeah, great point. So let me quantify it for you in terms of just our projections, right? With the caveat that who knows, let's see, margin for error. We're expecting a 230 basis point increase in vacancies for the United States over the next couple of years. So it's going to continue to slide till late 2021. For perspective, 230 basis points will get us to about 13+% vacancies. We're currently at or around 10 and something like 10% or so. Okay, and 13+% vacancies in the retail sector will be historic. That's retail overall. I was talking about malls earlier. Obviously, some places that are anchored by groceries and pharmacies that did not have to close are doing relatively better. But a 230 basis point increase in vacancies translates to around 60 million square feet of vacant retail space. Okay, now, the folks who are invested in the warehouse and distribution sector are chomping at the bits, looking at that, saying that vacant retail space is tantamount to a conversion in demand for online sellers, and therefore they'll need warehouse and distribution space. Not all of that 60 million square feet of vacant space will be converted into warehouses because of zoning policies. Usually you cannot build, or even a tear down of a mall, for example, will not necessarily admit an industrial building in there. So, if they could admit an apartment building or an office building, this will take some time, no? Because, hey, we're in real estate, right? So it's not like you can take product off the market and off the shelves because prices have dropped. So that's the occupancy side. Our expectation is that retail rents will fall by a record 11.1% in 2020 alone. But for perspective, 11.1% is almost 2 times the drop in retail rents from all of 2008 to 2011. We were at 6.2% over 3 years in that time period, nationally speaking, right? So it's going to take a hit on the occupancy side, 230 basis points increase, translating to 60 million square feet of available space. And then it's going to take a hit on the rent side, about an 11.1% drop in 2020, and another drop, I forget the exact number, in 2021, until things kind of stabilize in 2022. Now, you asked a question, when should you therefore jump in, right? My suspicion is that you'd be too late if you jumped in 2022. A lot of the deals are probably going to be had in 2021. Why not 2020? Because of all the uncertainties that we've been talking about so far. I'm not sure you want to jump in now because you might catch a falling knife. No? But in 2021, I think, once we settle where the administration is in November, whoever is going to be in office, at least that uncertainty is off the table. Early 2021, there are about 70 compounds currently being tested for vaccination and administration. Hopefully, there's something that's going to work out that's not going to compromise your immune system 6 months from now, right? That's the point of testing and waiting a little bit. So sometime in mid-2021 might be a really good time to look for well-priced opportunities. I hope that was more or less clear. And by the way, I'm really sorry for adapting to my question askers, no? When Rick asked me a question with an American accent, my American accent came out. And then suddenly, now that I'm talking to everyone else, I sometimes interject and throw in Filipino words. So yeah, sorry about that. That's just my habit.
That's good.
When you're answering Rick, you're Victor Calanog. When
Yes,
you're answering us, you're just B-boy, right?
Yeah, please. Nakakapagod ng English, no? Minsan.
Mr. Tanmantiong, do you have a follow-up?
No, I'm good. Thank you. Thank you, Victor.
Thank you very much. Did that sound like good news to you, Mr. Tanmantiong? When to sign more leases?
Yeah, lots of opportunities.
Yeah, I think so, especially for the better positioned folks who are going to take advantage. I think, there's going to be a lot of disruption in U.S. retail. We're already seeing it now.
As usual, no? There's been some stories about, and we got these questions before the chat from some of the signups. There are some stories that they read about how people will move out of cities such as New York and go to the suburbs, or even I forget what the term that I've read, or even one of the signups used, going to really more remote locations. It sounded a bit Robinson Crusoe to me, but maybe not that far. And here as well, the question might be, will there be a slowing of growth demand for urban space as opposed to something more outside, which is easier to transport anyway, because now people have gotten used here to not having to travel 2 hours in the morning and 2 hours in the afternoon. Maybe they'll want to find space there. Could you tell us a bit about that supposed possible migration from big cities to suburbia?
Yeah, so historically speaking in the United States, actually this isn't so far-fetched, right? In the late 1970s to early 1980s, US cities were actually in really bad shape. Coco, have you watched the movie Joker with Joaquin Phoenix?
No, I don't like watching very dark movies like that.
So it was a dark movie, but
I know the movie.
If you do watch the movie, that's actually what New York looked like in the 1970s. No, the dilapidation rate was about 14%. Today, the dilapidation rate in New York is less than 1%. In other words, how many buildings are so bad that you are not even allowed by law to enter it? Baka malaglagan ka ng something on your head. That's a dilapidation rate, no? That's what New York looked like in the 1970s and 80s. And actually, Americans were moving out of cities into the suburbs. And so we do wonder, and we need to be very nuanced about this, if, to your point, dense urban areas fall out of favor because of COVID-19, right? I mean, is it a coincidence that if you take a look at my heat map, it's always in coastal areas and dense urban areas where COVID-19 incidences are higher? Yeah, of course, it's density, di ba? Folks in New York who are in apartment buildings tell me now that they feel like they are living in giant cruise ships. Right? Because you're all in there. There's no isolation. When you go out into your hallway or press the button on your elevator, you're taking a risk. So if it's true that dense urban areas fall out of favor, my suspicion is that if you're looking for office space, sure, office rents will drop as these things get sorted out. We're projecting a 21% decline in office rents in New York for 2020. But on the occupancy side, it's actually very nuanced, because where will you move? Unless you move to a 100% remote working option, which I don't think a lot of companies will do, you might actually need more space for the employees you want to retain and attract, right? So CBRE is now marketing the 6-foot cubicle because you'll be in cubicles, but yet you'll be far enough from each other to prevent transmission. That means actually that net, your occupancy rate might actually increase in a metropolitan statistical area, because even if you move out of the city, right, you're not going to move to Idaho, you're going to move 20. So in the US, you as a big employer, if you move 25 miles further out from your HQ, you actually need to give your employees some kind of severance option. No, there's a cost because you're forcing them to relocate. So there's a natural constraint from moving too far away. The 25 miles is a pretty big radius, and we might see an increased demand of suburban office space. There might be a return of that quote-unquote trend, which was actually operative in the 1980s. So suburban office space vacancies was lower than CBD office vacancies up till around 1994. No? So that's interesting. This is nothing new in the US. And I do think that a lot of folks are chomping at the bits to say, oh, that's my opportunity. I've been speaking to a lot of developers who want to develop, multifamily around mixed use and suburban office space, because they believe that their residents are going to come there, and then there's going to be an exodus away from cities. But it remains to be seen. Again, my example is in 9/11. Everyone said people would leave downtown. Who would ever want to live in downtown Manhattan? Hello, I lived in downtown Manhattan. So it remains to be seen. I think some people will leave, but whether or not the magnitude of the movement is significant enough, I'm not predicting, for example, 5 years of negative office rent growth, right? I'm not predicting vacancies for the office sector to go to 100% in New York. So it's not going to be, I think, a mass extinction event. I think we need to be very nuanced about the discussion.
Before I ask my final question, and if there's any more questions, please raise your hand quickly, because we have a few minutes for that. Before I ask my final question, could I invite all of you or request all of you to Michelle, can we show the QR code? To point your cameras at this QR code, and if I could invite you to give some comments regarding today's activity, and just for our feedback. And if you share a comment, we might also, I'm asking you advance permission now, if we could share that comment in some of our materials. We'd really appreciate it. And as you're doing that, I'll ask my last question, Victor. And you were talking a while ago about, I forget, did you call it a capsule for workers? I forget the term that you used. Could you tell us, if you were to crystal ball it, what will be the biggest or most interesting change about real estate markets or real estate in the next few years because of COVID?
If there's one catchphrase that I would use to characterize the evolution of the built environment, is that I think more and more we will start thinking of real estate not as physical space, but as a service which can be unbundled, right? So in other words, we're used to thinking of the built environment as where you will locate your business, right? We're used to thinking of long-term arrangements. We're used to thinking of less flexible. I think over time, if you look at lease contracts, you will see it drawn up with more and more flexibilities, more and more contingencies. You will see a lot of space, even in the office sector, which are being constantly analyzed for utilization and efficiency. And if it's not being utilized efficiently, how can you monetize that space that you're on the hook for? So, example, a company like Convene in the United States, their business model is simply to go to office buildings, take a look at attractive but less utilized space, and literally run conferences and events out of them. No? So, you have offices na meron kang isang floor, walang nagpupunta doon, baka yung security guard ginagamit as the gym or something like, I don't know. If it's underutilized, how do you unbundle real estate as a physical entity and monetize that underutilized space? Does that make sense? And so I think whether it's retail, whether it's industrial becoming more like data centers, diba, to cater to the Netflixes of this world, whether it's office buildings becoming more like hotels because there's underutilized space, there's more of that melding and really that unbundling of not thinking of just space as, oh, pag office, office ka lang. Pag multifamily, multifamily ka lang. Pag hotel, hotel ka lang, right? And I think the ones who are able to really come up with a good value proposition that works. Kasi hindi naman, it's really hard to make something super flexible because how do you build a business model around that, right? I think if you the people the businesses who are able to achieve that mix will be the ones who will succeed over the long run.
I thought the flexible real estate model was WeWork.
Yeah, they didn't execute very well, no?
They didn't.
Okay, it's very interesting to hear you talk about leases because I guess now tenants and landlords might be negotiating over. Is there a provision there that if there's another outbreak, I get an immediate discount? So I don't know if that's something that landlords should fear, and brokers and consultants like Rick and others should begin to talk to their clients about. With that, unless there are any last questions, thank you very much, Victor, and we'd like to thank Bobby as well for doing this, and we'd like to thank all of you for participating. We hope to see you again in our future events. Victor, thank you very much for doing this. We hope to see you again soon to disprove all of the dark news that you shared with us.
I hope so. I hope so too. Be safe, guys. Thanks for having me.
As you know, ladies and gentlemen, Victor is in the U.S., so it's he's about to put his children to sleep. That's why we were a bit earlier today. But Victor, thank you very much for making this time.
Thank you so much, guys, for your flexibility. Thanks for having me.
Good night to Victor.
Good night.
Thank you very much, everybody.
Bye.